if you missed just the 10 best days in the stock market over the last 20 years, your wealth didn't just take like a little dip, it was practically cut in half.
Wow. Yeah.
Right. And the truly terrifying part of that statistic, those 10 best days almost always happen the exact moment your brain is absolutely screaming at you to sell everything you own.
It is, it's the ultimate paradox of building wealth, really.
Mhm.
I mean, the very instincts that have kept human beings alive for thousands of years, fleeing from danger, seeking safety,
Yeah.
those are the exact same instincts that will completely destroy your portfolio.
Yeah, which is such a stark contrast to how this industry is usually sold to you. You pick up a brochure for an investment fund or you open up one of those slick new financial apps, and it always looks incredibly pristine.
Oh, absolutely. The charts are always going up.
Exactly. You see these beautiful, smooth, upward trending charts. You see clean numbers. Maybe there's a picture of a relaxed couple walking a golden retriever on a beach.
Right, yeah.
It is presented to you like engineering, like physics, clean,
Mhm.
orderly, rational.
And it gives you this very dangerous illusion that investing is purely a mathematical exercise. It makes you feel like, well, if you just plug the right variables into a spreadsheet, you get the perfect outcome.
Yes.
But economic theory assumes that investors are perfectly rational actors who calmly weigh risk and reward. The problem is, theory never had to experience the visceral physical reaction of watching thousands of pounds just vanish into thin air.
Right. And that is exactly why we are so excited to welcome you to this deep dive today. We are exploring Gregory Scola's audiobook, The Leaking Pound, How to Build Your Wealth, and the Mystery of Money That Quietly Disappears.
A fantastic book.
It really is. And specifically, we are digging into Chapter 5, Part 4, which is aptly titled The Reality of Investing, because the core mission of our deep dive today is to tear down that brochure perfect image of finance. Okay, let's unpack this, because if we want to get to the truth of how wealth is actually built, we have to expose the messy, the emotional reality beneath the math.
Yeah.
Investing isn't about numbers. It's about human behavior under extreme, relentless pressure.
If you want to truly understand investing, you have to understand how real people behave when their own money is on the line. And to your point, this doesn't happen in a sterile laboratory.
Yeah, definitely no.
It usually happens on a random Tuesday.
Yeah.
You're sitting at your desk trying to eat your lunch, you glance at your phone, and you see a news alert that the market is tanking.
The worst feeling.
Right. Your heart rate spikes, your palms sweat. That moment right there, that is where the reality of investing actually takes place.
Skolba breaks this down beautifully by explaining that markets don't move just because of earnings reports or algorithmic trading. Markets move because people feel.
Exactly.
He outlines 4 primary emotions that actually drive all of this chaos, and I want to look at the underlying mechanics of each one. First, you have fear. And not just a mild concern, but that primal internal voice that screams, sell everything, the sky is falling.
And we have to look at why that fear is so overwhelming. Neurologically, your brain does not know the difference between a physical threat like being chased by a predator and a financial threat, like a 30% drop in your retirement account.
That is wild. So it's literal biology.
Pure biology. The amygdala fires up, your fight or flight response kicks in, and your body literally prepares to run away. That's why selling feels like a physical relief. You are escaping the predator.
Which perfectly sets up the second emotion, which sits on the complete opposite end of the spectrum, greed.
Oh, yes.
That's the voice shouting, buy everything, the sky is literally made of money. I'm talking about that infectious, suffocating FOMO.
Right, yeah.
You see a stock or cryptocurrency going to the moon, your neighbor is bragging about their returns, and you feel like you are the only person on earth missing out.
Greed is just the dopamine counterpart to fear. It's the thrill of the hunt. And then, when that dopamine wears off and the investment starts losing value, we shift into the third emotion, which is hope.
And hope sounds like such a positive word, but in investing, hope is lethal.
It really is.
It's that desperate whisper of, well, maybe this time it's different, or it just needs to get back to what I paid for it, and then I'll sell.
It's pure sunk cost fallacy. You are holding on to a sinking ship because you don't want to admit you made a mistake.
Exactly. And when hope finally shatters, you arrive at the fourth and most destructive emotion of all, panic.
Panic, yeah.
Panic is when logic completely leaves the room. Panic doesn't care about the spreadsheet. It doesn't care about your 10-year plan. Panic just screams, I don't care how much I lose, just make the pain stop. Sell it all.
What's fascinating here is how these 4 emotions create a massive gap between what we plan to do and what we actually do.
It really is a physical disconnect. It makes me think of an analogy. Theoretical investing is like reading a textbook on how to swim while you're sitting safely on dry land. It makes total sense on the page. Move your arms like this, control your breathing. But real investing is sitting in your warm bed at 2 in the morning, looking at your phone, but feeling like you've just been thrown into a freezing ocean.
That is so accurate.
The textbook goes completely out the window because you are just thrashing around trying not to drown.
Because your survival instincts override your logic.
Mm.
And when we experience these incredibly intense emotional swings, our natural human instinct is to try and outsmart the chaos. We think, well, if the ocean is this rough, I just need to time my jumps perfectly.
Yes, we try to dodge the pain. We try to perfectly time our entrances and exits into the market. We think we can sidestep the bad days and only participate in the good days.
Which is impossible.
Right. And that leads us directly into what Scola calls the illusion of timing the market.
It is perhaps the most dangerous illusion in all of finance. So many investors believe they can simply outsmart millions of other people. The logic seems straightforward to them. I will just buy at the very bottom when things are cheap, and I will sell at the very top right before things crash.
And as Scola points out, that is one of the most expensive mistakes you can possibly make.
Oh, massively.
To prove just how costly it is, he brings in a massive long-term study conducted by Fidelity Investments. They looked at market data over a 20-year period. Let's put that into perspective. 20 years is roughly 5,000 trading days.
Yeah.
Fidelity found something remarkable. If an investor missed just the 10 best days in the market over that entire 2-decade span, their total returns were dramatically reduced. Just 10 days out of 5,000.
It's staggering.
But wait, I have to challenge this premise for a second. Isn't the fundamental golden rule of investing to buy low and sell high?
In theory, yes.
So if I'm watching the news and I see a massive crash coming, or if the numbers are plummeting right in front of my face, why shouldn't I pull my money out? Why shouldn't I move to cash, stop the bleeding, protect myself, and then just jump back in when the waters are calm and safe again? It seems irresponsible not to do that.
I mean, it sounds incredibly responsible until you look at the mechanics of market volatility. You have to look at when those 10 best days actually occur.
Okay.
The Fidelity study highlights a crucial, counterintuitive piece of data. Those absolute best days in the market almost always happen immediately after the absolute worst days.
Wow. So they are structurally intertwined. You don't get the explosive growth without the terrifying drop.
Precisely. It's a phenomenon called volatility clustering. When markets panic, they don't just gently slide down, they violently swing in both directions. Institutional investors are rebalancing, algorithms are triggering, and panic sellers are exhausting themselves.
Yep.
So when you panic and sell during a crash, because you think you're protecting yourself, you are almost guaranteed to be sitting on the sidelines in cash when that explosive recovery happens right behind it.
Meaning you aren't actually protecting yourself at all. If you sell at the bottom to stop the pain, and then you wait for the news to announce that everything is safe again before you buy back in, you are literally just buying high and selling low with extra steps.
Exactly.
By trying to time the market, you aren't avoiding losses, you are permanently locking them in.
And that is the trap. The lesson here isn't about having a crystal ball. You don't need perfect timing. What you actually need is time in the market. Time in the market is the only thing that smooths out all of those terrifying drops and euphoric spikes.
But staying in the market requires navigating your own psychology.
Absolutely.
Which brings us to a brilliant interactive exercise that Scola includes in the text, and we want you, the listener, to do this with us right now. He calls it the panic test.
This is a great exercise.
It is. Because it's easy to say you won't panic when the sun is shining. But I want you to imagine this scenario vividly. You invest 10,000 pounds of your hard-earned savings, money you traded your life energy to earn. You wake up on a random Wednesday, you check your account, and the market has dropped 25%. 2,500 pounds are just gone, evaporated overnight.
Before you answer how you'd react, you have to acknowledge what your body would actually do. If I saw that, my stomach would drop. I would immediately start rationalizing. I'd think, I should just pull the rest out to be safe. I can always put it back next month.
Exactly. My chest would get tight. I'd start calculating how many hours of work I just lost. I'd feel physically ill. And you have to be brutally honest with yourself here. Everyone always says, I'd stay calm. I know the market goes up and down. I'm a rational, long-term investor.
Right, everyone says that.
But I'd stay calm is just the lie we tell ourselves before we actually need to stay calm. When that money vanishes, the rest of us just want to flee. Or, as Scola perfectly puts it, we feel an overwhelming urge to go make tea. Lots and lots of tea. Just something to distract us from the pain.
The point of the panic test is to acknowledge that the urge to flee will be overwhelming, and you cannot trust your panic brain to make a rational decision. So Scola advises writing a rule right now. While you are calm and thinking clearly, you literally write down, in this situation I will, and then fill in the blank.
He calls this your future discipline contract. You write it down on a piece of paper and stick it somewhere visible, inside your desk drawer or in your diary.
Yeah.
So when that Tuesday lunchtime crash inevitably happens, you don't have to think. You just follow the instructions written by your calm self, delivered to your panicked self.
It's a vital exercise, because if you think passing the panic test with a hypothetical 10,000 pounds is difficult, you really need to look at what happens when the entire global economy faces the ultimate panic test.
Oh, absolutely.
It's easy to discuss this in theory, but let's stress test this against history.
Let's look at a moment when the moving car of the global economy actually caught fire. Let's take you right into the heart of the 2008 financial crisis. This is where the theory of panic selling becomes a painful historical reality.
Right.
Let's set the scene for you so you can feel why the panic was so justified. Think back to 2008. This wasn't just a slight dip on a chart. The news headlines were absolutely apocalyptic.
You had a collapse in the subprime mortgage market that triggered a global contagion. Century-old historic investment banks like Lehman Brothers were completely failing and disappearing over a single weekend.
I remember that. It was surreal.
Global economies were shrinking at terrifying rates. There were actual rumors that ATMs might stop dispensing cash. The fear was systemic. It truly felt like the modern financial world was ending.
And in the midst of all that terror, millions of retail investors looked at their retirement accounts, saw their life savings cut in half, and they hit the sell button.
Yeah, they did.
And here is the crucial thing to understand. They didn't sell because they were stupid. They sold because they truly believed they were doing the responsible thing. They thought they were protecting themselves and their families from total, irreversible ruin.
If we connect this to the bigger picture, we can see the sheer tragedy of that 2008 panic. Scola has this brilliant analogy in the text for exactly how that moment felt.
Right, the car analogy.
Yes. He says that selling your investments in the middle of a massive crash feels like putting on a seatbelt. It feels safe, it feels prudent, but in reality, it is actually like jumping out of a moving car because you're scared of crashing.
You are almost guaranteeing the injury you are trying to avoid because something incredibly important happened after all those millions of people jumped out of the moving car in 2008 and 2009.
The market recovered.
It recovered.
It didn't happen overnight, but it recovered. And those investors who sold in a panic, they permanently locked in their losses. They turned a temporary paper dip on a screen into a permanent, devastating loss of wealth.
It's just brutal.
And because they were sitting in cash, waiting for an all-clear siren that the financial media never actually sounds, they completely missed the rebound. They had to sit on the sidelines and watch everyone else's wealth grow while theirs was gone forever.
Well, the people who stayed in the car.
The people who stayed invested,
Yeah.
the people who closed their eyes, gripped the armrests, and endured the terrifying ride they eventually recovered. Their wealth continued growing over the next decade to record highs. They got to feel quietly relieved.
Yeah.
The ultimate unshakable lesson of 2008 is that the market does not punish patience. It punishes panic.
It punishes panic. That is such a powerful framing. And to help you ensure that you are never punished by panic, Scola gives you another incredible actionable exercise in the text. This is called your crash rule. We want you to complete the sentence right now, in your head. If my portfolio drops by 20 to 30%, I will.
And the key to the crash rule is to keep it simple, actionable, and completely non-negotiable. It has to be an action you can actually take that prevents you from hitting the sell button.
Scola gives some fantastic, highly practical examples from the text of what your crash rule could be. You could write down, if my portfolio drops by 20%, I will do absolutely nothing for 30 days before making any financial decisions, just forcing a cooling off period.
That's a good one.
Or leaning into the British coping mechanism we mentioned earlier, I will go make a cup of tea, walk around the block, and wait. You can also write down a mantra. I remind myself that all past crashes throughout history ended eventually.
Yes.
But my personal favorite, and arguably the most modern solution, I will physically hide my phone from myself so I cannot check social media or look at my banking app.
Hiding the phone is probably the most effective strategy for the modern investor. The less you look, the less you feel. But resisting that urge to act, resisting the urge to jump out of the moving car when all your biological instincts are screaming at you to flee, requires an almost superhuman level of discipline.
It really does. It goes against every fiber of our being. So what does that level of discipline actually look like when you stretch it out, not just over a 30-day cooling off period, but over decades?
To answer that, Scola points us toward the absolute master of long-term thinking and psychological discipline, Warren Buffett. Specifically, the text highlights his legendary investment in Coca-Cola back in 1988.
Here's where it gets really interesting, because when Warren Buffett made that massive investment in Coca-Cola, the most instructive part of the story isn't what he did, it's what he didn't do.
Right.
Over the ensuing decades, there were recessions, there were market crashes, there were global crises. But he didn't actively trade the stock. He didn't react to every piece of short-term news or every quarterly earnings miss. He certainly didn't write panicked posts on internet forums at 3 in the morning. What did he do? He simply hate LD.
And decades later, that single investment has multiplied many times over. It continues to generate enormous passive income for him. It illustrates his famous philosophy. As Buffett famously said, our favorite holding period is forever.
Forever. Now, I have to push back here, again, on behalf of everyone listening. Holding forever sounds like a wonderful luxury if you are a multi-billionaire like Warren Buffett.
Sure.
But what about the average person? If I need to send my kid to university in 5 years, or if I want to put a down payment on a house, I can't just stare at my bank account, ignore a 30% crash, and hold forever. How does a normal person apply this?
That is a crucial distinction.
Yeah.
The rule of thumb is that any money you need in the next 3 to 5 years shouldn't be exposed to the volatility of the stock market anyway.
Right.
That should be in safer, accessible accounts. Buffett's advice applies to your long-term wealth, building your retirement, your decades-long growth. For that money, the lesson holds true regardless of your net worth.
Because it reveals this wild paradox at the heart of the text. Great investing isn't actually about taking action. It's about inaction. It's almost like getting into a 20-year staring contest with your own bank account. You have to actively, purposefully choose to do nothing day after day, year after year.
And we have to recognize that doing nothing is actually incredibly hard work. Holding an investment for decades requires you to completely ignore the daily noise of the financial press.
Yeah.
It requires trusting the decisions you made in the past over the emotions you are feeling in the present. It means aggressively controlling your impulses and, most importantly, embarking on a dopamine detox where you stop checking your portfolio every 5 minutes. True investing is about being gloriously, stubbornly patient, especially when everyone else around you is flapping and panicking.
Gloriously, stubbornly patient. I absolutely love that phrase. It perfectly captures the energy you need. To help you cultivate that stubborn patience, Scola leaves you with one final exercise in this chapter. This is the 20-year test. We want you to write down 3 companies or 3 broad ETFs that you truly believe will still exist and be thriving in 20 years. And crucially, you can't just list names. You have to write down why you believe in their long-term survival.
This exercise is so powerful because it is designed to force a radical shift in your perspective. It drags your brain away from the short-term dopamine hit of what's hot this week or what is a random influencer telling me to buy today.
Yes, exactly.
It forces you to think like a true business owner and a long-term investor, what provides fundamental value that will actually survive for decades.
So what does this all mean? As we bring all of these insights together, the core message from this section of The Leaking Pound is abundantly clear. True wealth isn't built by staring at clean charts in a brochure. It isn't built by constantly trading to try and outsmart the market or perfectly timing your jumps into the ocean.
No, it really isn't.
It is built almost entirely by managing your own psychology. It is about surviving those terrifying panic tests when the freezing water hits you at 2 in the morning. It's about writing your future discipline contracts, keeping your crash rules handy so you don't jump out of the moving car, and ultimately it's about finding that glorious, stubborn patience of Warren Buffett.
This raises an important question, one that really builds on Scola's warnings about the dangers of checking social media and doom-scrolling your accounts. If the ultimate historical secret to successful investing is glorious, stubborn inaction, literally doing nothing for decades, how much of the modern notification-driven financial industry is secretly designed to sabotage that?
Oh, that's a great point.
Think about the gamified apps, the push notifications, the red and green flashing lights. How much of the user interface you interact with every day is actually designed to trigger the exact emotions of fear and greed that make you want to act, trade, and ultimately ruin your own returns?
Wow, that is a deeply chilling thought to leave on. The very tools we use to manage our money might be psychologically designed to make us lose it through overactivity. Thank you for joining us on this deep dive into the leaking pound. We highly encourage you to go make a very large cup of tea, sit down and write out your personal crash rules, physically hide your phone from yourself if you have to, and remember the next time you see one of those pristine brochure perfect charts that the real test of an investor isn't in the math. The real test is in the mirror.